All right, Ken, let's get some individual names for you. You've got two names to buy, two names to avoid in this economy. I want to bring back in Ken Mahoney, CEO of Mahoney Asset Management. Ken, let's get right to it. With your first pick, it jumped out to me, and that's Palantir. This is a stock that has had a massive run up. Yes, it's been volatile, but it's up 170% since the start of the year. Some on Wall Street are cautioning right now, saying it's not the time to jump in, but you see more upside potential. What's the catalyst?
So the catalyst is government contracts. This doesn't really get all the buy ratings and strong buy ratings because of the way they came public. They didn't go through investment banking. They kind of did direct. So they kind of snubbed Wall Street a little bit. So they don't get all the love. But it's contract after contract. They hit a high yesterday at the open at 19, settling down around 17. Look, the runway, by the way, next month is the earnings. We don't like to hold a lot of positions overnight to earnings. Example, Netflix and Tesla. But we do think there's a little runway here to make some money. We think it's exciting longer term once we get past this earnings season, because again, it could be sell the news. But Palantir looks like in good shape. A good way to play AI outside NVIDIA, Microsoft, the obvious ones. This one makes a lot of sense to us.
You also like Pacer U.S. COWZ 100 ETF, ticker COWZ. Now, this ETF has a lot of exposure in oil and energy. What's the bull case there, especially with geopolitical risks like the ongoing Russia-Ukraine war?
Well, I always feel like there's some type of Saudi put or OPEC put, which anytime we get below $70 a barrel, here they come cutting, a million here, a million there. Our strategic reserves are very, very low. And again, we've had such a red hot first half of the year with tech. Again, I do believe some of that money will rotate into energy that's been off, or rotate into banks, which has not been all that exciting as of late. So with COWZ also, though, you do get Apple in there, Cisco, companies that have great cash flow. That means they're doing pretty well in this environment. And with that cash flow, those companies are actually buying back stock, they're raising their dividends, in some cases doing both. So you get pretty much a nice diversified blend, value and growth, with companies that can really grow their cash. And again, that really favors shareholders when you can buy back stock and raise dividends.
Ken, on the flip side, you've got a couple of warnings here for investors. Two stocks that you're saying stay away from. Both are telecom giants, AT&T and Verizon. We know, obviously, that Journal report recently calling out the fact that so many of these cables that the telecoms giants left behind are covered in toxic lead. We've seen a massive sell-off since that report, but what does that downside look like?
I still think there's more downside there until it just, look, at some point you want to go back and revisit when it starts making higher lows. But if you look at it, it's still a downtrend. And when these type of things pop up, think about OPEC, Valdez, and some of these other major stories, they don't just get written off after a couple of weeks. They hang, they linger, and next thing investors are sitting in quicksand with AT&T, Verizon. Again, the reason I picked those is that they pay high dividends, they look very, very attractive, and maybe they'll get a good turnaround. Maybe they will get higher lows. But at the moment, until they break the downtrend, again, I think it's a sucker's bet, because I do think there's still more, unfortunately, that come out of this negative sentiment, especially we're talking about lead poisoning, and you don't just clean that up in a couple of weeks and get off the front pages. They're going to be in the front pages for some time.
Yeah, and besides those unfortunate headlines surrounding the lead cable situation, are there other fundamental risks, you think, for these two companies?
Well, they do have a lot of debt, right? So, and look, I've always been in belief, instead of having an 8% dividend like AT&T does, just cut the dividend a little bit, pay down their debt, get rid of some, diversify some of their holdings and so forth. So the risk is actually, when you look at a chart and you see it going down in a strong market, there's a lot going on. But I would say one thing that keeps coming up about Verizon, AT&T, is the debt load that they have, the covering of the dividend, and believe it or not, if they cut the dividend, the stock may go higher because it could give them more breathing room.
All right, Ken, thanks so much for sharing that insight. Always great to get your perspective. Ken Mahoney, CEO of Mahoney Asset Management.